Good morning, good morning. What's going on, world? It's, you know what time it is, man. It's Generational Wealth Wednesday. And, this time I decided to actually do a video instead of trying to find a meme online and, sharing a meme online. I decided to try to be more in your face, direct. Um, and, of course, we're going to tackle those specific topics. So, today, I want to talk about um, college funding and how you can use life insurance as a means to, make sure you take care of your kids' college-related expenses and how to plan for that. It was something that was new to me, after I got, licensed and things like that, and I started learning about the different things that you can do with life insurance, and I just, my mind was blown, and I just want to start parlaying some of that same information over to you guys so that you can start implementing these strategies into your everyday life. So I guess before I get into showing you guys how you can calculate college related expenses, as you can see, this is one of the main reasons I wanted to do this video, because this is what it's all about, guys. So, it's all about your kids, and looking out for their future. And I'm not sure how, a lot of y'all came up or was raised, but if you're anything like me or come from a background similar to me, then you didn't come from a background of many means. So although we know it was our experiences and things that made us who we are today, you don't necessarily want your kids to have to go through that, same experience. And they should, you should be in a position to where they shouldn't have to start from zero. They just pick up where you left off, and of course, try to make more strides to get ahead in life, further than what you might have done. Like they say, it's all about your last name meaning something, So it's definitely my goal that Howard last name will definitely mean something for years and many generations to come. So again, I guess I'm going to share a story with you guys. So of course, as far as my college experience, I went off to, when I graduated from high school, I went to a 2-year college initially at South Georgia College. It's located in Douglas, Georgia. I was there, graduated with a degree in pre-allied sciences. So many of y'all don't know, but I actually wanted to do medical research. I wanted to be a scientist. So I went to sit in the laboratory and play with the, what you call them? I forgot what they call petri dishes or whatever, and do experiments all day long. So after I graduated, I went out to Howard University. Now, some of you may know that, but what you don't know is the hardships that I had to endure while at Howard, financially, mostly. But I won't, share too much, get into too much about that, my side story. But I do want to talk about a unique experience with someone that I encountered while there, and this person actually happened to be, she was my girlfriend at the time while in college, but I bring her up, I won't share her name, but I bring her up because the thing that was interesting to me was that Howard University is not a cheap institution at all, by no means, but she was able to attend college. She didn't have to take out any student loans. She pretty much was there on scholarship funds. So what's interesting about that, as I dig more into it, I remember asking her about her, her mom and her grandma, and I found out that not only, had her mom attended college, but her grandmama was a college graduate as well. And the interesting thing about that is that, down south, from the small town or whatever, my grandma, and this is not just my situation, but grandmas didn't really get past like third grade, because they had a lot of kids and they had to provide for those kids. So, to talk about college was well beyond, the scope of things. So that was interesting. But the key to that whole thing, what I took away from that is the fact that because her mom had already went to college and her grandma went to college, they knew what to expect. Therefore, they planned early. And this is what this whole video is about today. You gotta plan, because of course, you can't go to college. College ain't free. You gotta get paid for, whether it's student loans, whether it's money that's been saved up, or whether it's scholarships. Money is not free, and it's not cheap either, especially if you want your kids to get a good education. So, what I've pulled up, of course, if you've been paying attention to anything I posted lately, I've been talking about a new product. Well, not necessarily a new product, but it's a product from Nationwide. It's called a Index Universal Life, and most people, they use this Index Universal Life product for not only death benefit protection, but you can also use it for an additional source of supplemental income, as well as using it to pay for your kids' college related expenses. So what they've done, they designed a calculator that actually lets you see the cost of college, and how much money you should be setting aside to make sure that you be able to meet those financial obligations when that time occurs for your kids to go off to school. So what I'm going to do is demonstration purposes, because she's sitting right here. I'm just going to do my daughter, just so you guys can get an idea. And she's, how old are you, baby?
5.
She's 5 years old. All right, so right here is the college funding calculator that's provided to us at Nationwide. I'm not sure if it's open to the public, but of course, me being an agent, they provide it to us so that we can, show you guys. So my daughter's 5. So as you can see, the first question is how many years until she goes off to college. So I graduated from high school at the age of 17, so 18. I was 18 when I went to college, and I think that's pretty much the standard age for college. So I don't know, just later. So we're gonna say 18. So with her being 5, that's 13 years until she goes off to college. All right, current college savings, we're just gonna leave that at 0, because I'm pretty sure, it's not a new concept, but I'm pretty sure many of us in our age bracket or even younger haven't started, that process of saving for kids' college. Right now, you weren't, your main concern is just meeting today's obligations. So, annual college costs. So, what I'm gonna do, because like I said, I went to Howard. I'm gonna do the same thing for my kids. I want my kids to go somewhere like Howard, or a pretty reputable college or university. So if you don't know the annual cost of that college that your child want to attend, all I have to do is hit look up, right? So give me a second while it loads. All right, so the state, Howard is located in DC, and we want to do, of course, in-state would be if my kids were to attend college in Georgia, which they're, if they end up going to Howard, that's out of state. That would be considered out of state. So we're not looking at out of state just out of state tuition. They're going to need out of state tuition and room and board. So we're going to select out of state tuition and room and board. And as you can see, Howard University, $26,621, and that's annual cost. That's not for the entire duration. That's annual cost. So as you can see, it's pretty it's a pretty penny. So we're gonna select Howard University and numbers of years enrolled. Of course, ideally, you want to say 4 years, but I can tell you that usually doesn't happen. So we're gonna make room for that. We'll give ourselves a little bit of cushion. So we'll say 5 instead of 4, just in case. What happened? 5 years. All right, and let's see. We're gonna leave everything else pretty much the same. If you amount provided by other sources, like if you had additional sources to pay for college, rate of return, we'll leave that at 2%. Current tax rate, 15%. College inflation rate, 6%. See, this is something that's not factored in, when you're thinking about it. So when you look at the cost of college today, not factoring in inflation, the cost of college today is not going to be the same when it's time for your child to go off to college. So you have to be mindful of that. So we're just going to go ahead and hit submit. And so based on that, so we basing attending Howard University, out of state tuition, out of state, housing, basically. You're looking at a total cost of $320,000 and 78. $320,078. This, it make you think twice, right? And as you can see, the estimated savings that you would need per month, based on this calculations, is $790 per month. $790 per month, and that's for one child, guys. So, real quick, what I'm gonna do, I'm gonna hop into something that's called a illustration. So now, an illustration is basically gonna allow you to let me move this around so you guys can see it. So this illustration is gonna allow you to see cash value accumulation and things like that. So let me run this illustration real fast for you guys. Give me just a second. All right, guys. So we're back, and as I stated, I'm gonna do an illustration for you guys just so you can see what it looks like. So basically, all the inputs were a 5-year-old living in Georgia, and based on a $790 per month contribution. Now, as you can see, that gets you an initial death benefit of $3,544 and $3,544,223 on your child initially. So I know that's pretty significant, but keep in mind the whole focus is about allowing things to accrue as far as the cash value is concerned, so that you can have that supplemental source of income and pay for your kids' college-related expenses. You can use the funds for pretty much anything, and the money inside the account grows tax-free, and the withdrawals can also be tax-free if you do it correctly. So by taking a look at this, you can see you have the end of year one, but and the age at that time will be 6 years old. You already will have an accumulated cash value of $4,213, right? Doesn't really seem too too interesting or whatnot. So let's go to, let's say when she begins to be age 30. We'll just say age 30. So as you can see right here, you've been faithfully contributing the $790 per month, and in year 30, you have two columns. So let me make sure I explain this to you guys first. You have this alternate interest column, and you also have the assumed interest column. This column represents a 3.25% return. So this is the portion that's guaranteed. So this is like the same thing that you have if you have like a traditional whole life policy. This is the equivalent of that. This is if the market doesn't do anything, doesn't perform, because IUL, the crediting is associated with the stock market index. So the money is not directly invested into the stock market, but the crediting is associated with how that particular stock market index performs. So in this case, this column, you have an assumed interest. This is what we hope the market will do over the course of time. So that is credited. This is calculated based on the 6% rate of return. So at the age of 30, if the market performs the way we expect or the way we hope, you still have that $3.5 million death benefit, but you also have cash value of $335 already. $335,938. That's pretty powerful, and that's at age 30. So now let's jump to age 65. So when your child, of course, at that time, hopefully they've already began, taking over the policy and making payments themselves. So at age 65, look at this. Look at this. This is guaranteed. Remember, so it's guaranteed that it will be a cash value of $1,033 to $33,269. But if the market performs the way we hope, you're looking at a total cash value